In this presentation, we will take a look at the customer section of the homepage, which will include the primary forms of the creation of an invoice, the receipt of payment, and then the recording of the deposit. The recording of the deposit being in the banking section, but completing the customer or accounts receivable cycle. We'll enter this into QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We have restored this file in a prior presentation. If you don't have this QuickBooks file or the Get Great Guitars file, that's okay. You can follow along with your own file with your own data. We have the information and the open windows on the left side. I always open the open windows. Whenever opening QuickBooks, you can do so by selecting the View drop-down up top, go into the Open Windows list. Last time we took a look at the vendor section. This time we're going to be considering the customer section. We are in the home page. The home page will usually open when you open the company file or the QuickBooks file. You can open it and close it by, if I was to close it for example, then go into the company drop down up top and the home page. As we said in the prior presentation, as we know at this point, the homepage is a great tool for the flowchart to see the types of forms that will be involved by cycle. You want to start to think about things by cycle. And so now we're going to be taking a look at the customer cycle. You can call it the accounts receivable cycle, the sales cycle. Our focus here will be in this section, the creation of the invoice, to the receivement of payment, to the recording of the deposit, which of course is actually in the banking section. Then we'll go to the create sales receipt, which then funnels through to the record of deposit. So the full accounts receivable type of cycle, sales cycle, revenue type cycle, will typically start with the creation of the invoice. We're not going to get into estimates right now. We're going to go right to the creation of the invoice. Remember that when we learn QuickBooks, we need to learn the terminology that's going to be used within QuickBooks. So we need to know, for example, here, the difference between what an invoice is and what a bill is. We need to know the difference between what an invoice is and a create sales receipt. So an invoice is going to be something that's going to happen when we bill the customer. And notice here that's a little bit confusing because we have the term bill, or a customer might tell us, where is my bill for the work that has been done, right? Or that we need to bill the client, we need to bill the customer. We might hear that terminology, but and we might use that terminology. It will be used, of course, but it will kind of confuse the idea of the bill and the invoice. So remember, for QuickBooks purposes, when we are creating the bill to the customer, we call that an invoice. We're going to create an invoice, and that will distinguish between an invoice and a bill. The bill for QuickBooks is when we get the bill from somebody else. Somebody else, in essence, invoiced us. It's a bill to us. When we think about an invoice, then, an invoice is really us basically billing a customer or a client. And therefore, you got to keep those two things straight in terms of terminology. You want to learn the language of QuickBooks and know which form you're talking about when you're communicating with other people. So the longer format of the sales or revenue cycle will be to create an invoice, and that will be us billing the customer. You can imagine us basically sending out or emailing the invoice for work that had been done in the past or goods that had been delivered in the past, expecting then for us to receive a check in the mail. That means that we're going to have to track who owes us money. We will then increase the accounts receivable with this, the other side recording the revenue on the other side. Then we're going to be receiving payment. I would imagine or picture a check coming in the mail from a customer check coming in the mail. We now have received the payment. When we receive the payment, we're going to be decreasing the receivable, representing the customer owing money to us. The other side then going to undeposited funds, which is kind of a tricky type of step that most people don't see when you're thinking about normal financial accounting, because we just deposit into cash, a generic cash account. Within QuickBooks, however, we need to distinguish from where that cash is. Is it in our hands in the form of a check, or is it in the bank? We're going to put it first into undeposited funds, which means we have the check in our hand. Then we're going to go to the bank and deposit it. This also really helps with the step of grouping the deposits together in such a way that they will be in the same order as will be shown on the bank statement. That will really help us when we compare the bank statement to our financial statements. When we compare our books to the bank's books, when we do a bank reconciliation, in other words, we want the same grouping of deposits on the bank statement as is going to be in our QuickBooks system. This will also help with that process. So notice this happens with a type of company that basically does invoicing and does work and then bills the client or invoices the client and then expects payment to be received in the future. So something like a bookkeeping firm, an accounting firm, a law firm, those are all companies that will typically do the work and then invoice the client, which is in essence a bill to the client, and then receive payment at a future point. Now, there are going to be other types of companies that will actually, of course, get the money at the same point in time. So if we think about a shop, a store, then what's going to happen is that when we're in the store, we're going to basically take the stuff up to the register, and at the register, you can think of getting a receipt right there, the payment happening at that same point in time. We then increasing sales and the undeposited funds. Then we're going to take those undeposited funds, go to the bank with them, and deposit them into the bank. Let's consider these forms in a bit more detail now. If we first go to the create invoice, we think about the invoice that will then be created. Let's take a look at an example invoice by going back one. So I'm going to select the back or previous arrow. As far as the data input for an invoice, it should be very straightforward. We want someone that doesn't need to understand how to set up an invoice to basically just be able to easily data input an invoice. So what we're going to have is the customer name. We're going to have the template that's used, the date, the invoice number will populate automatically, the terms, and then we're going to have the item that will be sold. In this case, we're selling guitars. This is an inventory item. So they don't have to actually type this in there. We can imagine someone just basically saying, I want this guitar, right? And then we're going to say, well, we have that set up already in our items. It's an ELP, inventory part. It's an Epiphone Les Paul. If I just select that item, then we can tab through this and it'll actually populate the description and the rate for us, and it'll give us the amount. It will also populate the tax for us already, so that when we do the data input process, you don't have to do anything else other than know what the item is that you're going to populate for. Now, how does the invoice know that it's going to be an Epiphone Les Paul for $500 and so on and so forth? In order to do that, you need to set up the items. And that's going to be something we'll do when we go into the practice problems, but just to see them now, that is going to be in the lists drop down up top, the item lists. And so this is really what you want to understand, is setting up these inventory items and these service items, because these need to be set up properly so that when you invoice the client, it's going to be as seamless as possible. Even if you do your own invoicing, you don't want to have to type out the rate each time and refigure what the rate should be. How much should I charge for this at this point in time and whatnot? What you want to do is you want to set up a standardized system of how much you charge per activity you do, per hour, per function, whatever rate system you are using, and then simply populate that invoice and don't agonize over what the price of your service is going to be or how much you're going to be charging for the inventory. Make it systematic in some way, put it into the system here. Then when you populate the invoices, I'm going to close this back out with the X up top. It will then be very easy to data input. So notice as you enter the invoice, then it's not difficult to do the data input. It's a little bit more difficult, or much more difficult, not too hard, but much more difficult to set up the items so that the invoice will then be easy to populate. Now, it's also it's deceivingly difficult to know what the actual transaction is behind an invoice. So note what we have on the invoice. We want to consider the transaction every time. What's going to happen to the financial statements? What are the debits and credits, or which accounts are going up and down on the balance sheet and the income statement? You'll note that the guitar cost $500. We had sales tax of $25, which again populated automatically when we entered the data into the invoice. And that gives us what is going to be owed to us by the customer of $525. So what are the accounts that are going to be affected here? The invoice means that accounts receivable will be going up. Accounts receivable is the account representing people owing us money. Accounts receivable goes up by the full $525. Then the other side is going to be revenue or sales revenue, merchandise sales, but it only goes up for $500. The difference between those two is going to be this $25. That's going to be a payable that we have to have as a liability that we owe to the government. Now that's going to be if it was a service item and not an inventory item, that's all there would be. However, if we're selling inventory and tracking that inventory within QuickBooks, we're also going to have to be decreasing the inventory account by the Epiphone and the cost of that Epiphone, which isn't on the invoice because we don't want it on the invoice. However, we do want the invoice to drive the transaction. So this will actually record the reduction of inventory and the related expense or cost of goods sold for it for an amount not on the invoice but driven by the items. How can we find that? We go to the lists up top, then we go to the items list, and this is going to be the ELP Epiphone Les Paul. If I double click on that, then we're going to see that we have the cost of $400 and the price of $500. We'll talk about how to set these up again in a future presentation. I'm going to close this back out with the gray item here and the gray item here, closing this back out. Let's think about what an invoice would then do to the financial statements. So I'm going to close this back out. We're going to take a look at our main two financial statements, the balance sheet and profit and loss, by selecting the reports drop down up top, go into the company and financial, scrolling down to the balance sheet standard. Within the balance sheet standard, we're then going to go to the customized reports up top, and we're going to change the dates from 01/01/20 to 12/30. I needed to hit tab. 20 to 12/31/20. That's January through December 2020. We're going to select OK. And then, as we said, the invoice will increase the accounts receivable, the report that shows that people owe us money. So if I double click on the accounts receivable, that'll zoom into it, zoom into the detail for it. And if we scroll down, we'll see all invoices and payments. So if we're going to take a look at one of these invoices, I'm going to go back up top here and let's take a look at this one on number 7. This is an invoice on 2/20. And it's for Smith Guitars. That has $420 in the accounts receivable. If I double click on that, then we see the invoice here. This one at $420 in the receivable. This is on February 20th. If I close this back out, the other side of this, or the other side of the invoice, then is going to be on the profit and loss report. Let's then close this back out. Let's go to the profit and loss by going to the reports up top. We're going to go to the company and financial. We're going to go to the profit and loss standard. We'll change the dates up top once again to 01/01/20 to 12/31/20. That's January through December 2020. Let's then take a look at the merchandise sales. We're going to double click on the merchandise sales to zoom into it. And then if we take a look at the invoice on 2/20, we then see the $400, the other side of that amount. If I double click on that, you'll see that that is for the $400 that we charged, not the $420, which includes the sales tax. The difference being the $20 that will be increasing a liability for the tax that's going to be paid that we had to collect and owe to the government. Closing this back out, let's take a look at that. Closing this back out, that's going to be back on the balance sheet. That's going to be in the balance sheet in the open windows. I'm going to go to the open windows, select the balance sheet. We're then going to scroll down. We're going to take a look at the liability, sales tax payable, 125, double clicking on that. Then we can see this on 2/20. There's our invoice. There's the $20 increase in the liability. Closing this back out, we also note that the invoice had to decrease the inventory. Inventory is going to be up top. Here's inventory. If we double click on the inventory, we can see that on the 2/20, we have the invoice for Smith Guitars. That's going to be for $320. $320, if I double click on that, that $320 is not on the invoice, because we don't want it on the invoice, although the invoice is driving the transaction because it knows what the $320 is given the item that we have set up. Closing this back out, closing this back out. If we then go to the profit and loss, we'll see the other side of that $320, which will be in the cost of goods sold. Within the cost of goods sold, we'll double click on it. We'll then take a look at that invoice. There's the other side of the $320, double clicking on it. We then see our invoice once again. Closing this back out, closing this back out. So you can see an invoice is deceptively complicated. There's a lot to it, and we'll discuss more of how to put that together, and we'll review it many more times as we go through example problems for it. Now we're going to go back to the home page. So if we go back to the home page, The next thing that would happen is we would then receive the payment. So we're imagining now that we issued the invoice, we mailed it, or we emailed it. Now we're getting a check in the mail. So we're getting a payment. So if we select the receive payment, then we'll get a screen that will look like this. And if I go back to the prior received payment to take a look at an example, we'll go to the previous. Here's our example. We would choose then, in this case, Anderson Guitar being the customer that we got the check for. The check came in the mail for $275. That $275 is connected then to the invoice. So if I was to double click on this item down below, that connects to the invoice, which has been paid by this receive payment item. Closing this back out with this X up top, here is going to be our receive payment. What's going to happen with the receive payment then? The receive payment means that the accounts receivable is going to be going down, and the other side by default will be going into an account called Undeposited Funds, because you'll recall we're getting a check. That check, however, isn't in the bank yet. It's in our hand, and therefore we put it into an undeposited fund account by default, unless we adjust that setting within QuickBooks, which we'll talk about later, so that then when we go to the bank, we can deposit everything in the same kind of format, the same kind of grouping that will be found on the financial statements. Let's close this back out, the same kind of grouping that will be found on the bank statement. The bank statement, which will be tying out to our books in the bank reconciliation. Let's close this back out. Let's consider what that would look like on the financials. If we go to the balance sheet up top, we know that the undeposited funds then will be increasing. So if I double click on that, this is the undeposited funds up in the assets section. Double clicking on that, we see that we have the two items here being the payment and then the deposits. So the payment item is the received payment. If we were to select one of the received payments, say this one on 112, double click on that, we see that we have our customer received payment here. Same type of form. Closing this back out, closing this back out. The other side then of the received payment go into accounts receivable because they owed us money. Now they paid us off. If we double click then on accounts receivable, you'll note then we have the payment forms, which are going to be the same received payments. If we select then, for example, this Anderson Guitars payment, double clicking on it, then we get back to the received payment form. Closing this back out, closing this back out, you'll note then that we have this account called Undeposited Funds that will be increasing as we receive the payment. Again, that's an unusual type of account for most people in just financial accounting because usually we just have cash that we post to and don't have to deal with the difference between a checking account and the cash that we have on hand, which is not yet in the checking account, and then grouping that cash that we're getting from various sources possibly into the same kind of format that will be given on the bank statement as we deposit it into the bank. So if we go back to the home page then, that's going to be the final step. We'll actually make a deposit. Anything that's going to be a received payment here will then have a little 1 or something, or 1, 2 or so that are going to be undeposited funds that will then populate if we were to select them in the record deposit section. So if I select record deposit then, for example, we get this pop-up that says, hey, there's this received payment amount. We can choose it if we so choose. If we close this back out up top, if I go to a previous deposit, here's an example of a deposit where we have the undeposited funds being the other side. In other words, what does a deposit do? Obviously, it increases the checking account. That's what a deposit is going to be doing. The other side, in this case, because it was for the received payment amounts, which will typically be the case, hopefully, most deposits being from customers, will then go to undeposited funds, decreasing the undeposited funds. Closing this back out, let's take a look at that. If we go to the balance sheet then, when we go to the undeposited funds, if I double click on that, if we double click on the undeposited funds, we know we can see that when we have a deposit, if we double click on the deposit, then here's going to be our deposit form, and that then is going to be decreasing undeposited funds. Closing this back out, closing this back out. The other side then, of course, going to cash. If we double click on the cash, double clicking on the cash, we're going to have the increases as we see the deposits increasing here. Closing this back out. Then if we go back to the home page, That whole system is going to be set up if we go through accounts receivable. Now, if you imagine a situation, say we have something in the store, like a cash register in the store, for if we sell guitars in our example problem and someone just brings up the guitar to the storefront, then we can go into the create sales receipt directly, skip the accounts receivable. And this would be like you can think of it just basically creating the receipt. This will be driving the transaction. If we go to the prior form here to see an example, we've got the customer. It's very similar to the invoice type screen, and date and so on. And then we have the item. Again, very similar to the invoice type screen. The difference here being, and let's actually go to a previous item until we get to an inventory item. This is a service item, doesn't have any sales tax. We're not selling inventory. I'm going to keep going back. Here's an Epiphone. So this is actually inventory item. So in this case, what would the transaction be? Well, we know that we didn't get its accounts receivable is not going up. However, undeposited funds will be going up because we got paid at the point in time. We got paid at the cash register. The other side then is going to go to sales, so that undeposited funds is going to go up by the $525 that we're going to get, including the sales tax. The other side then going to sales. For the 500, the difference being 25, the 25 then go into a payable that we have to pay the government, sales tax payable. This will also, like the invoice, be decreasing inventory by the cost which is not on the sales receipt because we don't want to show it to the customer, but the sales receipt will be driving that transaction and it will be increasing the cost of goods sold account and expense account. Let's take a look at that. If we close this back out and we go back to the balance sheet, then we can think about the undeposited funds. If we double click the undeposited funds, you'll notice that it will be increasing by the sales receipts as well. So a sales receipt will be increasing the undeposited funds. If we double click on a sales receipt, we get to a sales receipt. This is going to be one that's a service item. Closing this back out, we know the other side of a sales receipt is going to be on the profit and loss report. So if we go to the profit and loss report and we go to the merchandise sales, double clicking on that, we'll then see that we have the sales receipts here. It's going to be increasing by sales receipts or invoices. Double clicking a sales receipt, we then see the sales receipt. The difference, in this case, the 25 is going to go to a payable account if we sell inventory for the sales tax we owe, closing those two out. Back to the home tab, the payable account, back to the balance sheet in the open windows. The payable account is in the liability account. This is similar to an invoice where we have the sales tax payable, double clicking on that. And we see these being generated from time to time by the sales receipt. So here's the sales receipt generating that $25. Closing this back out, Then we also know that in the inventory would be going down. Here's inventory. Double clicking on inventory, we could see that it decreases by sales receipts as well. For example, this 400. The 400 in this case not on the sales receipt, but being driven by the sales receipt. QuickBooks knows what it is given the form that it is, or the item that's being used, the Epiphone, the ELP. Closing this back out, The other side then is going to be on the profit and loss report. So if we go back to the profit and loss report, it's going to be in the cost of goods sold. Double clicking on that, we see that this is going to be increasing by the sales receipt. For example, the 400 here, double clicking it, we have our sales receipt. Closing this back out, we're going to go then back to the home tab and note then that the sales receipts could be gathered into undeposited funds, checks, payments, and whatnot, as will the cash that is received after invoicing. Both of those then can be grouped together. We take everything out of the cash register, everything we got in the mail in terms of checks, cash, whatnot. We then go to the bank with it at the end of the day. We will then cash it in the same kind of format, the same grouping that will be seen on the bank statement so that we can reconcile easily. Now, those are the main forms that we want to think about within the customer section. I'm not going to get into any more detail here because those are some of the more complex type of forms. They're easy to do the data input for, but they're more difficult, as you can see, to set up to make the data input easy to do, and they're more difficult to see what the effect will be on the financial statements. So think about these type of flows when you would use the create invoice versus the sales receipt, what the difference in terminology is between an invoice and a bill up here in the vendor section, and then go through these and just try to consider and think about what's going to happen on the financial statements. Get good at going back to the financial statements and saying, this is what happens when I enter a bill. This is what happens when I enter a receive payment and a deposit. And we'll practice that in detail when we actually go through a practice problem in the future.